It's gonna start recording just now, combo. Okay, today's we're gonna look at patterns and then we're gonna cover triangles, the symmetrical triangles, ascending and descending. We're gonna have wedges, the rising and the falling wedges, and then we're gonna look at bullish and bearish flags as well as rectangles. All right, and we're gonna go into some support and resistance, trying to identify them, look at them in theoretical basis, and then also look into the chart to identify them. And then we're gonna look at some other patterns as well, like your double bottom and your double top, and your head and shoulders, and the inverse one, and also the upright one. Okay. So what we have here is the triangles, and then I don't know. Can you guys see my screen? Bogan. All right, cool. So what we have here is a symmetric triangle. So what you can see is that this side is symmetrical to the other side. So what you're gonna have is that you will have an upward trend, and as it's going upward, it's gonna retrace a bit, going down to form the second point. So it's gonna hit a turning point at point 1, and then it's gonna retrace a bit, forming the second point at point number 2, and it bounces, goes up to point number 3, which is essentially lower than point number 1, and then it goes down to a higher point than the previous low. So this is your previous low, so it's going to be higher than that. And then now with this triangle, it's not really forming a certain trend, as because if you recall, the essentials of an upward trend is that it forms higher lows, right? And then it also forms higher highs. In this case, you have higher lows being formed as well as lower highs being formed, right? Which is a bit of confusion because an upward trend is identified by higher highs. So this is where now you are forming a triangle because they're about to converge, right? So that's what you have, and then you have essentially your point 4, which is a lower high, a higher low than that, than the previous low at 2, and then with that. So when you're trading this, you are waiting up. So you're gonna draw a trend line joined by 2 points, and then draw a trend line on the downside joined by 2 points. So the trend line on the downside shows the uptrend, and then the trend line on the upside shows the downtrend. So, and then what you're looking for is for the point when they're converging. You know that the market cannot continually converge up to, you see this infinite point here, this tip. So it cannot continue to form this zigzag up to that point. So essentially the market will have to break out of this triangle. So that's what you're looking for. So you're gonna be looking at this trend. So this is more like a trend, a retracement. So what you're gonna have is that if it was trending upwards, then after it forms this triangle, then it's gonna break out on the upward side, continue with the upward trend. So that's what you're gonna have here, which is the breakout. So usually when you trade this, you have your stop orders, or you can actually wait for it to break out, have confirmation candles after the breakout, then you can trade there after it is confirmed with the confirmation candles, right? And then you also have the downward trend 1, which continues. This is a retracement for the downward trend. So it was trending downwards, and then it retraces going up to point 2, down to point 3, and then goes up to point number 4, and then after that it breaks out from there, from the trend that is going up on this bottom side. I hope you are able to see that. So essentially what you do also is the same, you trade it the same as the upward trend 1. So with this one, you also have your stop orders. So what you're gonna do is you're gonna wait for the market to close below with a strong bearish candle, And then when it does that, then at least if it breaks through this level at point number 3, then you can actually sell. Then when you sell, you can usually when you sell, you're gonna sell up to a certain point, which will be the height of this triangle here. So which will be essentially the height from point 1 to point number 2. So that's how it works. Okay, let's go into ascending and descending triangles. I just wanna make this a proper presentation. Let me just increase that a bit. All right. Cool. All right, and then, okay, that's what we covered. Okay, so you have your ascending and descending triangles. So your ascending triangles, it's going from the bottom, from the bottom to upward points. So what you have is you have your resistance level, which is the level that the market would respect as it's forming the ascending triangle. So what's going to happen is with the upward trend, there's a level that the market cannot break. So this is your resistance level. This level, it cannot break this level. So what it does is it's gonna trend upwards while bouncing at the same level, which is essentially what you see there. So the market went down, went up, bounced on the same level, went down again, and then it went up to the same level again, went up to the same level again until it breaks out, right? So you can have about 2 to 3 bounces on the same line. So when you have 1, 2, 3, then you know that, okay, you're actually having the ascending triangle. So as long as what you have on the downside is an upward trend on the lower side, so you have your new lows being higher than the previous low. So this new low is higher than that one, and that new low is higher than that one. So that's when the market is forming the ascending triangle. So it's going up. So it shows a strong upward trend. It's just that the market is respecting a certain level, which is this resistance level, right? So in the market, you can find that this is more of a range than a specific price, right? And range can be 10, 20 pips difference. So it bounces within 10, 20 pips within the previous level. Say it bounced here, then it can bounce at a level higher than that by just about 20 pips or 10 pips. But as long as you can be able to spot the range that it is bouncing at. So you will have this closing maybe a bit lower, and then that closing maybe just around the same level. So it's just around the same level. So you don't actually have to have the line. You can have a triangle tool that shows you that highlights the entire range, which will be this range. So you can have a triangle around here, and then it can show you when the market is bouncing there, then that's when you know that, okay, it's forming the ascending triangle. So once this trend line, this resistance line is broken, then you can buy from that point, which you would buy after seeing a strong bullish candle or a certain pattern that you can that shows you that the market is is becoming bullish. So what you're gonna have is you're gonna have a strong bullish candle that's gonna close above this line, and then when it closes above that line, so when you buy, your take profit will be the height of this triangle, which will be this from this level down to somewhere here. And then when you measure that height, that's when you're gonna measure it from the buying point to a certain level price that you're gonna have. So that will be your take profit. And to minimize your risk, your stop loss will be somewhere below this point, this resistance level, so which has become your support level in this case. So it will be below that level. That's what's going to happen with the ascending triangle. And then the descending triangle does the opposite of the ascending triangle. Instead, it bounces on a support level, which is this line that you have here. That is a support level, and this support level is respected by the market. So what the market does is it bounces back and then continues to downtrend as it bounces on the support level. So it's a support because it's difficult to break down to it. So it's supporting this market, right? So that level that you have here is a level that is supporting the entire market up there. So whatever happens is the market is respecting that level, and then the moment it breaks down, you know it's gonna go down with the force. So it becomes a free fall. So what you do is you're gonna sell at a point when it breaks down, and then you're gonna wait for confirmation candle similar to the buying point. The selling point, you wait for a confirmation candle, and then you'll have a massive bearish candle forming downside, and then after it closes down, then you can sell. When you sell, you will have your stop loss just above this line or above the support region, and then that's how you trade it. And your take profit will be the height of this triangle, and then that's when now when you're done selling, you can set up your take profit to be from this level down to a certain point, which is respecting that height there. Okay, so do you guys have any question with regards to ascending and descending triangles? Do you understand them? All right, I'll take that as a yes. Okay, so this is what I was showing you about how to trade the triangle, right? So this is your symmetrical triangle. We went through it. It was the first one that we went through. So it's forming lower highs. So these are the highs that you have. This high is lower than that one, and that high is lower than that one, and it's forming higher lows. So that low is higher than that one, and that low is higher than that one, the previous one. So what you have is you're gonna wait for a breakout. So it can break out anyhow with the symmetrical triangle. So what you have is, as it's breaking out, it's gonna break out. If it breaks out on the upside, then from the breakout point, you're gonna your take profit will be up to the level, to the height of the triangle, which will be that height that you see over there. So this is the height of that triangle, and you're gonna measure this height. So you can measure it on MT4 or MT5 and be able to drag the measuring line and put it just after the breakout. So when you put it just after the breakout, then you can be able to drag and adjust your take profit to that level of the breakout, right? So that's how you do it. And on the downside, you do the same thing. If it breaks down, then you take the same height and then you put it at the level of breakout, and then essentially your lowest point will be your take profit in this case. All right, and then you have your rising wedges. So your rising wedges, you have a trend line that was trending, forming a zigzag, and then when it reaches a certain point, it retraces. So it pulls back. You have some bears entering the market, and when it pulls back, now it starts forming some form of a triangle that is converging. So you have your highs that are being formed, but these highs are not that high. The margin between the previous high and this and the new high is very low. So they have a small gap between the two highs. So you're gonna have these highs that are having small gaps in between them. So the distance from that high to that, the gap between that is small. So you're gonna have these forming, and then you're gonna have your new lows still new lows still forming higher than the previous lows. That's what you're gonna be having. And these, what they're doing is they're gonna be converging. So this squeezes, and as it's squeezing, you're gonna have to, if it was trending upwards, it usually reverses the trend line, and then you have your breakout at some point. So in the market, you can be able to see how it plays. It won't be as sharp as this. So this is just a schematic sketches to show you how it can behave. But in the market, it behaves. You just have to spot it nicely, because it won't be so clear as these lines that you see here. If you're trading trend lines using a line chart, then some of them you might be able to spot them with the line chart, because the line chart, when it turns around nicely. And with the candlestick chart, you can have your wicks forming, which are your shadows forming, and then some of them, they can be a bit of they can be a bit confusing. So trend line graphs are better when it comes to identifying these wedges, right? And then what you have is on the other side is a rising wedge, which in this case you had your trend going down, and when the trend was going down, it was a downtrend, and then it rises up. As it's rising up, it breaks down to the downside, so it's continuing the trend, right? So in this case here, it was a trend reversal. So this is how it forms as it's reversing the trend, and then on the continuation of a trend, this is how it forms. These are almost similar, if not similar. So what you do is you always want to be on the safe side. So you can either, so when you're trading, you're gonna trade guided by your trend line. So as you see here, you have a downward trend line, an upward trend line, which is on the downside of the market. So as on the downside of the trend, as it's going up, you're just waiting for the trend line to be broken. So when the trend line gets broken, that's when you start trading. So in this case, if it had broke the trend on the upside, then you would trade the upside, right? So we just don't have an example where it broke on the upside. But if it broke on the upside, then you can trade the upside. So it means that you're gonna buy and then continue to buy up until the height of this rising wedge. Okay. So that's the rising wedge for reversal. So you had an upward trend and then it reverses the trend. It's no longer going upward. And then you have your trend continuation rising wedge. It was downtrend, and then you have your rising wedge, and then it starts trending downwards. And then now you have your falling wedge. So your falling wedge is more or less the same as the rising wedge. And in this case, it's falling, as the name suggests. So the trend, you have your downtrend, and then now you are having a trend reversal falling wedge. So you have it forming a mini downward trend. So that mini downward trend that you have there is the opposite of the upward trend that was formed by the rising wedge. So with this downward trend, you trade it the same as the rising wedge, and then you wait for it to be broken. As it breaks either on the upside. For the reversal side, it's gonna break on the upside because you were having a downward trend, and then now when it breaks on the upside, you're gonna start buying. And then similarly with the continuation, when it breaks on the upside, you start buying as well. But in this case, your trend, your main trend was trending upwards, and then it's just this was a reversal. So like you have a bit of retracement, and after the market retraces, then it goes up again to continue with the strong trend line, right? You will see this often in the market. Okay, so these bullish and bearish flags, they are more like your mini channels, but now you have them in either downward or upward channel. So in this case, your bullish flag will be a downward channel that you have forming after a mini upward trend, or it could have been a strong upward trend. So with this upward trend, you have the market consolidating, forming a bit of a channel. So it means that on the downtrend, it's hitting the same level, and on the upper side, it's hitting the same level, and on the downside, it's hitting the same level. So in these levels have the same distance. So that's why you have these lines being parallel to each other. So it forms sort of like a channel going down, and then that's a bit of a reversal, and up a bit of retracement, and after that downward trend of a channel, you're gonna have a breakout on the upside. So when you have a breakout, it's gonna essentially break your trend line, which is that line, the upside of the channel. So when it breaks that, that's when you start trading. And then when you trade, your profit targets would also be the height of this bullish flag. So you would measure that height, and then you can place it as your profit target. Or in this case, you can use Fibonacci retracements or Fibonacci levels, the ones that are above the 100 mark level. You can have 161 mark level, which is essentially, if this was your 0 point and this was your 100 point, then the market retraces up to a certain level here. It's gonna go up to a certain level up there to form. Sorry, let me admit someone to the meeting. So it's gonna go up to a certain level up there where you're gonna take your profit, right? I'll show you how you can use Fibonacci levels to target your profit. Okay, and then on the downtrend, you have your downtrend, and then you have your bearish flag. It's trending upwards, and this is trending upwards. You have these two lines that are parallel to each other forming a channel, and it's gonna break downwards. And when it breaks downwards, then that's when you're gonna start trading. So spotting these is crucial in the market. So you will often see this in your hour. Essentially, every time frame has it actually. So you often see it in any time frame. It's just that if you go to weekly and yearly monthly time frame, it's too big. But if you go to your hourly time frames, then you can see more of these, because you can have so many trends that are happening. So you're gonna spot a downward trend, and as you spot a downward trend, then you can be able to see when it's retracing a bit. So that retracement can either form bearish flag, which will be your upward channel for retracing, forming a sort of like a more bullish trend, upward trend. And after that, it breaks down and continues trending with the main trend. All right. Cool. So you can have this schematic to assist you with your targets for profits. So this is your trend. So you had your trend, and then it formed the channel that you have on the downside. So after forming that channel on the downside, so you're gonna have your first target. So you can either enter two positions, depending on your risk appetite. So when you have two positions that you enter after buying, so this is your breakout level. So when the market when the market breaks from this downward trend, then you can have this measured height as your first target. So you're gonna measure that height and put it up just above the breakout level, and then your take profit will be your first. The height of this will be your first target for the take profit. And if you have your second position placed just after the breakout as well, you're gonna have your main trend line, where the trend line starts, right? So then you're gonna measure that height, and that height will be your second target. And then that target would essentially be much bigger than your first target, because you can be looking at a bigger trend line. So as I was saying, when you use Fibonacci levels, what you're gonna have down here will be your 0, and here it will be your 100. And if you use the Fibonacci, it's gonna give you a level of 161.8 somewhere here at your second target. So that will be your second target, but this will be your intermediate target. So with some people, they prefer to just take their profits on the first target, just the height of that flag, right? Cool. Let's go to the other one. We have these rectangles. So these rectangles, they are more You can call them rectangles or you can call them channels. So with the channels, you have the market consolidating over a certain range of price. So you have a lower bound and an upper bound region. So you have this lower bound that the market, when it trends, it bounces off that level. It keeps bouncing off the same level, and then the upper bound is the level where the market bounces off, and then it goes down. So it respects that level. So you can so once you are able to predict this rectangle, you can enjoy trading inside the channel. So what you do is, since you have identified, say your market was trending upwards, and now you have identified that the market is forming some sort of a channel, right? So all you need is just 2 points on the upside and 2 points on the downside. So you're gonna have those 2 points on the upside and 2 points on the downside. So once the market forms these 2 points on the downside, then it bounces off, then you know that, okay, it's respecting this level. So you can place your trade going upwards and you take your profits at this level, right? And then your stop loss will be just below this line that you have here. So it will be below, if you're not using the line graph, when you're using the candlesticks, would be just below the maximum week, the lowest week that you're gonna have below here. So that's what you're gonna have down on the downside. And then when it bounces up, going up, that's when you're gonna sell, right? And then usually when you trade this, if it's on a small time frame, you're mostly highly leveraged, so your risk is a bit higher, so that you can maximize on your profits. If it does go opposite your direction, then you can lose just small amounts, because your stop loss will be just below the support line, right? And then when you sell here, you can also be greedy and enter another position here and then close it when it goes down there. So you're gonna sell here and then close the position when it goes down, right? And then that's depending on how much profit you have made and if you're comfortable with trading the channels. So what happens is when the market breaks out of the channel, it's gonna form some sort of a small trend, and then it forms a retracement, and then it bounces off again. So usually it's gonna test this level that it had respected so much within the channel, right? And in some cases it doesn't do that. It just breaks off and then shoots up. And most cases you have it forming a small trend upwards and then bouncing on the same level, on the same previous level. And then when it bounces on the previous resistance level, it has declared this previous level to be a support now. So it's gonna bounce off and then it shoots off, and then it shoots up. So once it shoots up, you're gonna trade the height of the channel as your profit target. So that height, you're gonna measure it, and then it will be your profit target, right? And if it was a continuation of a trend, you can also use Fibonacci retracements to identify your take profit level, which in this case could be your 161.8 level. Okay. And then you have a bearish rectangle. It behaves the same way as the bullish rectangle, which is you have the same channel, and then you're gonna trade the height of this channel will be your take profit target. So it's gonna break downwards, and then it's gonna have a retracement a bit. Usually when it's breaking on the downward side, mostly in the market, what I've observed is that it just free falls. You hardly have a retracement. You hardly have this, the market goes down a bit and comes back and then goes up, goes down. Most cases, it just goes down, right? So it goes to your target quicker than it would in an upward trend. Okay. So I'm gonna go through this other book. I'm gonna send it to you guys also. So there's a book by Baby Pips. It's I don't know if you guys can see that. Let me just share it with you. I just want to show you some of the things that we didn't cover on my presentation. Can you guys see my screen? Leslie, can you see it?
Yeah, I can.
Okay, cool, thanks. At least someone is talking. All right, great. Okay, we have covered drawing trend lines before. So, and then this is what we're covering, the channels, but we're only looking at the ones in sideways, which is what you have here. So this is the channel that we're looking at. But as the market is trending upwards, you can have a channel that it's forming as it's trending. So you can also be able to trade that. So as you're trading this, you can buy and sell at a higher point, and then wait for it to retrace again, and then you buy again, and then you sell at a higher point, right? So that's essentially what happens with the channels. As you are trading them, you can trade within the channel. And to enjoy the benefits of trading the channel, if you see it like this in a say 4-hour chart, it's better to zoom into the chart and go into a 1-hour chart and be able to take the opportunities in an hour chart. So with the 1-hour chart, if this was the case in the 4-hour chart, then in an 1-hour chart it will be much more visible. So I'll open my trading platform, and then I'll just identify some of the channels for you so that you can see them. Okay, I think I should just do that. Yeah, let me just open my trading platform so that we can just look at some of the patterns. All right, can you guys see the platform? Okay, so this is the demo account I opened for this class so that we can trade it together. And yeah, so what we're gonna do is we're gonna just try to identify some of the channels. Let me just delete this, that, right? Okay, let's delete that, delete that. Okay, I want to show you something with this downward trend that you have here. So if you go to your equidistance channel, you can have that. And in this case, this will be your channel. And that will be your more like your downward channel. So the market goes up, comes down. In this case, it broke down a bit, and then it went up again, came down, bounced on the same level or on the same line, and then went up again, bounced on the same line downwards. So what you have is this trend being formed here. So once you're able to identify 2 points on the upside, so you will be having that as your first point and maybe these two as your second point, and you have that as your initial point, and that is just good enough to be a second point on the downside. So you can be able to draw your trend, these two lines that you have here, right? So just so that you can see that, so you can have that, you can identify that as your first point, and then the market goes down. This is gonna be a bit tricky because this, what it means is that the market was supposed to trend like this, but it didn't, right? So this was a false break. So you have it, this is a false break on the downside. So you have the market going to this level, and then it quickly retraces back upwards to a different level. And when it does that, now you have that higher level as a second level. And then when it goes down, you can have this as a second level on the downside. So you can draw your trend on the platform. Sorry. And when you do that, so this is what you'll be having, right? It bounced, and then it's gonna go up to a certain level. When it does that, it touches that level, you're gonna trade it, you're gonna sell it to a certain level downwards. So with me, if I'm trading the trend lines, I hardly sell off at exactly where my line is. So I'm more conservative. So what you do is, if you buy at a higher point, if you identify your target price as in this case, say level 104.664, which is that price over there, then you'd want to sell it a bit, some points below that, before that, right? So usually, because the market can bounce off before it hits your target, so you just want to be conservative and have a margin of safety, such that even if the market doesn't reach your level, at least you're able to lock some profits, right? And bouncing off, it bounces off to this level again, and then it goes up. So here it was just forming zigzag on a downward triangle, right? So I don't know if there's anyone that has questions so far, and if you guys are comfortable and be able to identify these triangles, channels. Are you guys with me? Okay, I just want to show you what I saw here so that you can just go through the process, how I'm analyzing. So like here you have a strong bullish candle. This is on a daily chart, and then it's going up. So what I see here is candles are consolidating. So when candles are consolidating in a big time frame, then in a small time frame, it means that they were bouncing off between two prices, right? Which would be a definition of a channel. So what you're gonna have is, you're gonna zoom into the 4-hourly chart, and then you still see that you have a bit of small candles on this side. So you wanna look into that area to see what's happening. So you zoom in further to hourly channel, 1 hourly time frame, and then you can see that, okay, in this case you can be able to spot out a bit of something. There we go, and that's your channel right there. So you have that channel that is happening. We can just do that. Cool. So if you look at the line graphs, with the line graphs, it just shows you that, okay, the market is respecting that level on the upside, and the market is respecting this level on the downside. Okay, and then so when you want to trade now, so you'll be looking at this zigzags being formed, the market consolidating between two prices. In this case, it's your 109.004 and around 108.683. So what you're gonna do is you're gonna you were having this is what do you call it, a bullish flag, right? So what you had is you had a downward trend that was happening before, and now you want to trade the upside of this what do you call it, channel. So what's going to happen is when the market breaks the upside of the support level, what you see is that it forms a small trend going up. Then let me just draw it, a small trend going up. Then after this trend, it trends down just to test that level, and that's what I explained when I was explaining the bullish flag, the bullish rectangle. So when you have this, it's gonna trend upwards, and then it's gonna trend downwards a bit to test the same level, and then once it bounces off that level, then you're gonna start entering again. So what you see is on the upward trend, right, as I mentioned, it often does this. On the downward trend, it often does the opposite, which is what just happened here. It just shoots. On the downward trend, it's just gonna free fall. It's just gonna fall down, right? So on the upward trend, it's gonna go up a bit and then retraces just to test the level. And once it has tested the level, it's gonna shoot up to your target, right? So in this case, you can have this target, the height of this as your target. And then once you trade it, if you buy after it bounces here, then you'll be taking your profit somewhere there. It's essentially about 280 points. So I said I'm going to show you how you can use the Fibonacci tool to identify the buying the selling point position, right? So what you're gonna do is you're gonna take the Fibonacci tool here, and then you're gonna just measure this height here that you have, this wave that you have, that trend that you had, and after measuring that trend, the take profit will be somewhere in this level. That will be your first level of take profit, which is 161.8. And in this case, it reached that level and then went beyond to 261.8. As you can see, the market usually respects these levels that are formed by Fibonacci. So what you see is that once you have entered your position just after the retracement, then you're gonna take your profits at that level 161.8, which in this case is a bit more than the height of the channel, 393 points, right? So with the height of a channel, it was about 300. So this is about on the other side is 390 something points. Okay, yeah, that's what you have here. And then if you are opening two trades, then you can take your profit at the second level, which will be 261.8, and you're gonna take about 860 points. So depending on your leverage, that's a lot of money. So that's essentially how this channel works. I don't know if you guys have any questions and know how to use these tools that I'm using. Do we have anybody that has any question? I'm about to wrap up now. So is there anybody who has a question? Do you guys understand how I use the Fibonacci to determine the exit levels and how we use the channels to determine the entry levels? So with the channels, you're gonna trade the breakout, and then with this one where the market is gonna break out on the upside, giving you an upward trend. When you trade the breakout, you want it to retrace a bit, and then once it retraces, then you can open your buy. And if you zoom in to 30 minutes, then this becomes a more visible trend. So you can be able to see how this is behaving on this side, on the inside of the channel. And as it breaks out, if you check here, you had this strong bullish candle that broke out first, which is that. Let me just zoom in for you guys to see that strong bullish candle. And when that strong bullish candle appears, it sort of like signals you that you're having a strong direction on the upside, right? So that's when that means that you were not really trading what was on the inside of the triangle. You're just waiting for the triangle to be breaking out. Because if you were trading what was on the inside of the triangle, then this could have been a painful trade, because you had some bearish candle and followed by another bearish candle. So this bearish candle tells you that it's strong, and then it's telling you that we're gonna go down. And then you had another bearish candle. After this, you would assume that you can be able to sell on your triangle. So you'll be trading the zigzags that are being formed on the triangle. But in this case, if you want to trade the breakout of the triangle, then you forget about trading what is on the inside and focus on trading what is on the outside. So you're waiting for the signal that signals you to be on the outside, which means that you're waiting for the breakout. You had this first strong bullish candle. It seemed as if it was breaking out, and then it closed high. This was a strong bullish. It was bullish from the open up until the close. So the market opened. Okay, let me just do that. The market opened at a certain point and then closed at a certain price, and then it didn't really form any wick. There's just a tiny wick. I don't know if you guys can see that. So tiny, but it shows you that whatever was happening at that moment, there was more buying than selling, right? And then after that, you had this reversal candle that just reversed all that you had. But what happened is this week that happened here, this shadow, is what could have deceived you a bit in terms of a breakout. So that's why when I said if it breaks out, you wait for a bit of retracement, then you trade after it has retraced a bit. So it's gonna test the previous level, then you trade it. So here it broke up. So after forming this bullish candle, it formed another bullish candle for a moment, then it went down, right? So that wick that you have here, or the shadow, it means that the market went up to that certain level, and then went up to that certain level, and then went down again. Then that means that the bears took control, and for some time, then you have this other candle that just formed here, which is more bigger than that one. So it's more like a bullish engulfing candle. Bullish engulfing candle usually swallows the 3 previous candles in terms of height. So if you see this one, it swallows almost all these 3 candles that you have behind here, even the small ones. So what you have is it signals a strong bullish trend. So what it means is that whatever is going to happen here is that the market is going to go up. It's guaranteed to just go up, right? Okay, 90% of the time is going to go up, right? Because nothing is guaranteed in this market. But 90% of the time is going to go up. And I just want to show you another candle that is important. You have this strong bearish candle. In this case, it swallowed about 2 to almost 3, including these small ones. So it's a strong bearish candle. So what it means is that your market is gonna go down at that moment, right? So these candles, they mean something. So if you enter after that, you're gonna have a bit of retracement, and then but essentially it's gonna go down. That's what it means. So what you have is in this case, after the breakout, you had a small trend upward, and then it went down to test the same level of the channel. After testing the same level of the channel, it went up. So that's when you would have bought, right? So if you were trading this, you would look at add it this way. Just form a small downward trend. So these trends, they assist you in identifying breakouts. So what you have is if you go on a 50 minutes chart, you just have that low, that high, and that previous that lower high that you have here, and then it's forming that downward trend. So you have your breakout here, which if you go on the 30 minutes chart, you have a strong bullish candle that just broke out, and then it went up. So you're gonna trade that strong bullish candle that went up. So you are protected by this now your support level, which was your resistance level. So then after trading that, then you can take your profit at your 161.8 level, and you can take another profit at 261.8. So your stop loss would be somewhere below that. If you look somewhere below this line here, the blue line, so your stop loss, if it's below that, that's about 180 points to 300. So this is almost 1:2 risk, and if you're taking it up there, that's more than 1:3 risk. So that's a good risk to reward ratio. Okay, I think that's it for today. Do you guys have any other question with regards to what we covered? All right, Leslie, do you have any questions that you want to ask? Are you comfortable with what we covered so far?